welcome to the research desk.
We are beginning a 10-part series today. It's titled The Allocation Equation.
Right, and our whole objective in this first installment is really to deconstruct the mathematical reality of cross-asset portfolio construction. I mean, we need to confront the most pervasive, emotionally seductive macroeconomic narrative out there.
And to do that, we really have to transport ourselves back to the structural fracture point of global markets. We have to go back to the reality of March and April 2020.
Exactly. Consider the physical and economic reality of those specific weeks. Global commerce didn't just, slow down. It effectively ceased by government mandate.
The flight boards at major international hubs like Heathrow, JFK, Changi, they went entirely blank. Supply chains completely froze.
And in the financial markets, we witnessed dislocations that, models predicted should only happen once in 10,000 years. Think about West Texas Intermediate crude oil futures.
Right, the absolute benchmark for global energy.
Yeah. It violently broke the zero bound. Traders were literally paying counterparties $37 a barrel just to take physical delivery off their hands.
Because storage at Cushing, Oklahoma was entirely full. I mean, the global economy was staring into a deflationary abyss. It was a sudden stop of cash flows that threatened to bankrupt the corporate sector in a matter of weeks.
And then the policy response arrived. And it arrived at a scale and velocity that fundamentally rewired investor psychology forever.
Absolutely. The Federal Reserve, operating in outright panic, expanded its balance sheet with unprecedented aggression. They absorbed Treasury issuance, mortgage-backed securities, and even, corporate bond ETFs to stabilize failing credit markets.
Congress simultaneously authorized trillions in direct fiscal transfers to citizens and businesses. The M2 money supply, which is the broadest measure of circulating domestic liquidity, just went nearly vertical on the charts.
When the dust finally settled, roughly $5 trillion of combined monetary and fiscal force had been injected into the United States economy, and in an impossibly short window.
The psychological outcome of that intervention was immediate. And, it permanently altered how capital is allocated to this day.
What followed those March lows was a market recovery so fierce and so completely decoupled from traditional economic fundamentals that it burned a perfectly clean chain of causality into investors' minds.
Stocks had just experienced the fastest peak-to-trough bear market in recorded history, and suddenly they ripped higher while the physical economy was still in lockdown.
The S&P 500 recovered all of its pandemic losses and eventually doubled from its lows. Gold broke out of a multi-year consolidation, surging past $2,000 an ounce.
And Bitcoin, it was temporarily left for dead, near $5,000 during the March liquidation cascade, but it ignited a rally that carried it beyond $60,000.
Real estate valuations disconnected entirely from historical income and rent ratios. We saw bidding wars for suburban homes sight unseen. Everything just went up.
Everything. And because human beings are biologically wired to seek clean, simple, causal explanations for complex phenomena, a consensus narrative crystallized almost overnight.
The narrative was incredibly simple. The Federal Reserve printed money. More dollars were introduced into a closed domestic system, and those dollars chased the exact same finite pool of assets.
Therefore, prices had to rise. It's an elegant story, perfectly logical on its surface, and it's completely undisputed by the vast majority of market participants.
It feels right. But the central question of this series is whether feeling right translates to mathematical truth.
So let's clearly establish our positions on this. Where do you stand?
Here's where I stand. The money printer narrative is a statistical myth at the monthly horizon. It possesses near zero predictive power for tactical asset allocation, and it leads portfolios into mathematically unsupported risks.
Well, I maintain the opposing stance. Broad money creation establishes an undeniable structural monetary floor for asset prices over a multi-year horizon.
A structural floor?
Yes, it fundamentally alters absolute valuation baselines. When you fundamentally debase the denominator, the fiat currency itself, you alter the absolute baseline for every scarce asset in the system.
But the danger of investing based on an emotionally satisfying decade-long story is that it breeds severe statistical laziness in the present.
I wouldn't call it laziness. The money printer narrative is not merely a psychological comfort blanket. It is the mathematical gravity of a fiat regime. You cannot inject $5 trillion into a system and claim it is a statistical myth.
Your argument regarding a structural floor is theoretically sound in a vacuum, but the market does not trade on a decade-long horizon.
The capital has to go somewhere, though, and the repricing of assets over the subsequent decade is the empirical proof of that debasement.
Right, but institutional allocators, hedge funds, and retail investors actively rebalance their portfolios month to month. Millions of investors have spent the last half-decade using your long-term macroeconomic anchor as a flawed tactical timing signal.
So you're saying they're misapplying the macro data?
Exactly. They look at a chart of the M2 money supply going up and assume they must buy equities or gold this month. We must examine the mechanics of the data, not the emotion of the narrative.
Okay, fair enough. To test the validity of this relationship, we must first establish a strict definitional baseline. We need to know what money printing actually means mechanically.
Because when market participants loudly claim that central banks are printing money, they are universally pointing to the raw, gross expansion of the M2 money supply.
Let us define M2 clearly for this framework. M2 tracks the absolute physical quantity of cash, checking deposits, savings deposits, and retail money market funds in the economy.
It measures the theoretical capacity of liquidity in the system.
Right. So when the government sends out stimulus checks, or when the Fed buys bonds from commercial banks and credits their reserve accounts, M2 expands.
And from the end of 2019 through the peak of the expansion, the raw M2 supply rose by an enormous 47%.
That is a staggering figure. Nearly half the money that had ever existed in the history of the United States was created in a matter of months.
It is staggering. But looking at gross M2 in isolation creates an illusion of available, actionable liquidity. We must transition from the illusion of gross numbers to the reality of effective liquidity.
Which means we need to talk about velocity.
Yes, that transition requires a rigorous understanding of monetary velocity. It's the massive blind spot in the consensus narrative. Money only possesses economic gravity when it actually moves.
I completely agree with that premise. If the Federal Reserve creates $1 billion and that billion sits entirely dormant in a commercial bank's reserve account, it is not bidding up the price of stocks.
Or real estate. Similarly, if a household receives a $10,000 fiscal transfer and out of pandemic-induced fear leaves it perfectly static in a savings account, the effect is totally muted.
The inflationary and asset pricing effect is fundamentally different than that household immediately spends it on goods, services, or brokerage deposits.
Velocity measures the turnover rate of the money supply. It is the frequency with which a single unit of currency is used to purchase domestically produced goods and services.
So we have to look at the stark reality of the post-2019 data. Yes, the raw M2 supply rose by 47%.
And if you stop your analysis there, which is exactly what the financial media and the money printer advocates do, you assume a 47% liquidity blast hit the system at full force.
But concurrently, the velocity of that money fell by 14%. The system was flooded with capital, but the transmission mechanism of that capital basically ground to a halt.
Think about the mechanics of this with a localized analogy.
Right. Think about this for a second. Imagine a closed economy, a small manufacturing town operating with $1 million in total physical cash.
Okay, $1 million in cash.
If that money changes hands 10 times a year, the factory pays the worker pays the grocer pays the local farmer buys equipment, the town is generating $10 million of transactional economic activity.
So the velocity is 10.
Exactly. Now, imagine the central bank drops another $1 million in cash from a helicopter into that town, doubling the gross money supplies to $2 million.
The residents grab the cash.
They grab the cash, but they are terrified. The factory is closed, a virus is spreading, and the future is entirely uncertain. They take that new $1 million plus half of their original savings and lock it entirely inside a bank vault.
They stop spending.
They completely stop spending. The velocity plummets to 3. The total money supply on paper is much higher, but the effective economic activity, the actual bidding power in the streets, has collapsed.
So to find the true effective liquidity in the macroeconomy, we cannot just look at the headline money supply. We have to multiply the expansion by the drag.
Right, walk us through the math.
We take our 47% increase in raw M2, which is a 1.47 multiplier, and we multiply it by the 14% velocity drop. That's our 0.86 factor.
And the result yields an effective liquidity growth of only about 28%. Roughly 40% of the supposed money printing was instantly neutralized by slower circulation.
People hoarded the cash.
They did, yet I refuse to accept this as a total dismissal of the narrative. Doesn't a 28% increase in effective velocity-adjusted liquidity still represent a massive, undeniable upward force on nominal asset prices?
It's significant, yes.
I mean, even after accounting for the velocity drag, a 28% injection into the valuation denominator is a structural shock.
It is a shock. But you are isolating the United States, which is a fundamental error when we are pricing globally fungible assets. Domestic liquidity does not exist in a vacuum.
You're talking about cross-border flows.
Exactly. Capital flows seamlessly across borders. An investor in Frankfurt can buy the S&P 500 just as easily as an investor in Chicago. We have to examine what I call the dollar paradox.
The relative versus absolute liquidity argument.
Yes, the United States grew its raw M2 supply by roughly 51% over the extensively measured period leading into the subsequent tightening cycle. However, Europe expanded its M2 supply by 32% over a similar window.
And Japan and the UK were engaged in their own massive quantitative easing programs as well.
Right. The United States dollar index, the DXY, is a relative measure. It compares the dollar against a basket of major trading partners, predominantly the euro.
So when we price global microeconomic assets, particularly commodities like gold, silver, and oil, we must adjust for cross-border monetary expansion.
You cannot just look at the Fed. You must look at the ECB, the Bank of Japan, and the People's Bank of China. If every major central bank is debasing their currency simultaneously, the relative exchange rate shock is muted.
The net relative effect of monetary expansion between the United States and Europe was only about 13%.
Exactly. Measuring domestic money printing without netting out the equivalent actions of foreign central banks is a fundamentally flawed approach. It assumes the dollar operates in an isolated test tube.
I accept the premise of relative global liquidity, but we must apply this refined formula to the ultimate, undisputed proxy asset for the money printer narrative to see if it holds up. We must test gold.
The classic inflation hedge.
Right. For thousands of years, gold has served as the baseline measure of fiat debasement. We need to calculate what I define as the monetary floor for gold, based strictly on the math we just agreed upon.
The gravity concept.
Yes. This monetary floor calculates the minimum absolute price pressure justified purely by our velocity-adjusted money growth. It is crucial to understand what this floor represents. It is gravity, not a GPS.
Meaning it doesn't give a precise daily target.
Exactly. It's not a coordinate telling us where gold will trade on a specific Tuesday afternoon. It is the fundamental, absolute baseline beneath which the asset should not theoretically fall. Assuming the mechanics of fiat currency debasement hold true, of course.
Let us execute the math on that baseline to see exactly where the gravity sits. In 2019, before the macroeconomic structural break of the pandemic, gold was trading at a stable baseline of $1,523 an ounce.
Okay, so 1523 is the base.
Yes. Now, if we take the precise 26% effective liquidity multiplier we just derived, accounting for both the M2 expansion and the heavy velocity drag, and apply it directly to that 2019 price, we arrive at the mathematically calculated monetary floor.
For April 2026.
Right. That structural floor sits at roughly $1,964 an ounce. That is the price the money printer actually bought. But the current reality of the market tells a completely different, wildly disconnected story. I mean, as of April 2026, gold is trading at roughly $4,800 an ounce.
It is.
I want the scale of that deviation to fully register. Gold is currently trading at 2.44 times its mathematically justified monetary floor. It carries a staggering 144% premium above what our velocity-adjusted money printer model can possibly explain. It's a massive gap.
If the Fed only bought us up to $1,964, where on earth did the other $2,800 come from? You cannot dismiss a move of that magnitude as statistical noise. The money supply established the base, but something else entirely took over.
Exactly. It comes from forces completely divorced from the domestic M2 data series. The fatal flaw of the mainstream money printer narrative is its obsessive, myopic focus on the Federal Reserve.
It ignores the rest of the world.
It completely ignores the massive structural shift in global sovereign behavior. Central banks around the world have become persistent, aggressive, price-agnostic buyers of physical gold.
And the primary catalyst for this shift had absolutely nothing to do with domestic U.S. monetary policy.
No, it was the unprecedented freezing of Russian foreign exchange reserves in early 2022. Think about the geopolitical earthquake that single event caused.
The G7 coalition immobilized roughly $300 billion of the central bank of Russia's sovereign wealth overnight.
That action served as an immediate, terrifying wake-up call to every sovereign nation on Earth, particularly those in the Gulf states, Asia, and Eastern Europe.
It demonstrated unequivocally that fiat reserve assets held in Western jurisdictions carry severe geopolitical counterparty risk, whether it's U.S. Treasuries, Eurobonds, or deposits at the Federal Reserve.
Right. If you are managing the sovereign wealth of a nation in an increasingly fractured geopolitical landscape, you suddenly realize your reserves are conditional. They exist only so long as your foreign policy aligns with Washington and Brussels.
In that environment, gold rapidly transitions from an archaic, non-yielding relic into mandatory, non-seizable financial insurance. Nations began repatriating gold and buying newly mined supply at an unprecedented rate.
The People's Bank of China orchestrated a massive multi-year accumulation program, and they were entirely independent of whether the U.S. M2 supply was ticking up or down that month. That sovereign panic is what drove the premium, not retail liquidity.
We must also factor in the pure market mechanics and momentum structures that dominate modern asset pricing. Once sovereign buying pushed gold decisively through its prior historical resistance levels, an entirely new classification of capital entered the market.
The quantitative strategies.
Exactly. Trend-following funds, commodity trading advisors, and quantitative momentum algorithms do not sit around calculating M2 velocity or cross-border liquidity differentials. They simply buy absolute price strength.
When gold broke out, algorithms bought the breakout. It created a self-fulfilling feedback loop.
Furthermore, you have institutional pension allocators evaluating the geopolitical landscape in 2023 and 2024. They recognize the rising probability of regional conflicts, supply chain weaponization, and persistent structural inflation.
Driven by deglobalization.
Yes. So they began aggressively treating gold as a structural macro hedge, permanently increasing its weight in their model portfolios. They were completely agnostic to the monthly changes in the U.S. monetary base.
They were buying the geopolitical reality, not the M2 print.
I concede that the money printer undeniably built the concrete foundation. It established that unyielding floor at $1,964. But entirely different macroeconomic forces built the massive skyscraper towering above it.
Which forces us to confront the most critical juncture of our entire analytical framework.
The tactical reality.
Exactly. If the narrative only explains half the long-term structural move in gold, the most sensitive proxy asset for fiat debasement, how does the narrative actually perform when subjected to a rigorous statistical test at the tactical horizon?
The timeline where investors actually manage their portfolios.
Yes, month to month. The long-term floor is theoretically interesting, but it is practically useless for an allocator deciding whether to overweight equities or bonds at the end of the quarter based on a central bank liquidity report.
The test we designed to answer that question is brutally simple. It's entirely objective and derived directly from the regression analysis in our quantitative datasheet.
Break down the test for us.
We ran the monthly changes in effective liquidity, which, remember, is the gross M2 supply multiplied by our velocity factor, against the monthly asset returns from 2014 through the present day in 2026.
Across multiple assets.
We tested this exact relationship across 8 major highly liquid asset classes, to definitively measure the correlation. The premise of the test is undeniable. If the mainstream narrative is true, if liquidity is the omnipotent driver of market returns that the media claims it is, the data will show a tight, highly correlated, mathematically significant relationship month to month.
The chart should move together.
They absolutely should. So what actually happened? Think about this for a second. When you look at the raw regression outputs, what do you see?
When I first reviewed the raw regression outputs from this test, the sheer lack of correlation was staggering. Wait, they spent $5 trillion and the monthly R-squared is 0.008.
It's hard to believe.
Let me translate what that statistical output actually means for portfolio construction. The beta coefficient for gold in this regression is negative 0.117 with a p-value of 0.28.
But the R-squared is the key metric here.
An R-squared of 0.008 means that less than 1% of gold's month-to-month price variance is explained by changes in M2 and velocity. Over 99% of the asset's movement is driven by something else entirely.
Less than 1%.
Furthermore, the p-value, being well above the standard threshold for significance, indicates that the relationship is entirely indistinguishable from pure, random statistical noise.
We are looking at the foundational asset of the inflation hedge narrative. Millions of investors buy gold specifically because they see the money supply increasing.
And yet, the monthly tactical signal from that data is mathematically non-existent. It is a ghost.
Methodically walking through the rest of the asset classes reveals a graveyard of strongly held macroeconomic assumptions. Let's look at the S&P 500.
The ultimate benchmark.
The U.S. equity market shows a positive beta of 0.108 to effective liquidity. Directionally, that slightly aligns with the narrative. Liquidity goes up, stocks go up.
But what about the explanatory power?
The explanatory power, the R-squared, is an abysmal 0.007. Less than 1% of the monthly variance in the U.S. equity market is actually driven by our effective liquidity measure.
Earnings, margins, interest rates, and behavioral sentiment drive the other 99%.
Exactly. And the commodity sector is equally damning. West Texas Intermediate Oil shows an R-squared of 0.007.
Wow.
Silver, often touted as high beta gold and supposedly highly sensitive to monetary debasement, shows a negative beta with an R-squared of 0.004.
That completely breaks the silver narrative.
It does. Even real estate investment trusts, the REIT sector, which is constantly pitched by wealth managers as the primary leverage beneficiary of monetary expansion, shows a negative beta and an R-squared of 0.007.
Across all of these hard assets and equities, the confidence intervals cross zero.
Statistically, you would have the same predictive power, flipping a coin, as you would reading a Federal Reserve liquidity report to predict next month's asset returns.
And we must address the most egregious psychological trap in the entire liquidity narrative: Bitcoin.
Oh, the Bitcoin delusion.
Yes. I refuse to accept the mainstream explanation that Bitcoin is purely a liquidity sponge, and the regression data explicitly proves why. When you run the numbers on Bitcoin against effective liquidity, the beta coefficient is a massive, incredibly seductive positive 0.738.
A positive 0.738 beta.
This is exactly where the analytical error occurs for the public. A casual observer, a retail investor reading a crypto blog, or even a traditional macro analyst sees that high positive beta, stops their analysis immediately, and declares definitive victory.
They conclude Bitcoin is the ultimate, hypersensitive money printer asset.
They assume it moves 73% faster than the money supply, but they ignore the variance. We must look at the R-squared.
And what is the R-squared?
The R-squared for Bitcoin against effective liquidity is 0.014. That means over 98% of Bitcoin's extreme monthly price volatility is driven by factors entirely, completely unrelated to M2 and velocity.
Over 98% is unexplained by liquidity.
The price is driven by localized adoption cycles, the mathematical mechanics of the block reward halving, regulatory news out of Washington or Asia, and pure, unadulterated speculative retail fervor. Using M2 to time Bitcoin allocations is using a broken compass to navigate a hurricane.
To help conceptualize the severe disconnect between the long-term reality and the short-term noise, think about the relationship between the ocean's tide and the individual waves crashing violently on the beach.
I like this analogy.
Over a decade-long horizon, M2 and nominal asset prices travel together. The gravitational pull of the money supply slowly brings the tide in. The overall water level of the entire ocean rises.
That is the monetary floor we calculated for gold. It is real.
Exactly. But tactical investors, hedge funds, and retail traders are not trading the tide. They are standing on the beach, attempting to predict the exact height, velocity, and crash trajectory of every single wave hitting the shore minute by minute.
Using nothing but a monthly tide table printed by the Federal Reserve.
The tide table is accurate for the decade, but it is the completely wrong mathematical tool for the frequency of the waves. It cannot tell you what the S&P 500 will do in October.
That analogy perfectly isolates the failure of tactical application. We understand the tide, but we cannot trade the waves with it.
However, we must remain intellectually rigorous and address the entirety of the quantitative data sheet without bias.
Is the entire dataset pure noise, or does effective liquidity actually matter to anything on a monthly basis?
Well, there is one single glaring exception out of the 8 major asset classes we tested.
20-year-plus U.S. Treasuries, long-duration sovereign bonds.
Yes, the beta is negative 0.225, and critically, it successfully clears the threshold of statistical significance with a p-value of 0.0229.
It is the only asset where the relationship is not mathematically random.
We need to intellectually unpack why long-duration sovereign bonds serve as the solitary exception to this rule of randomness. The intrinsic structural mechanics of long-duration assets dictate this sensitivity.
A 20-year or 30-year Treasury bond is fundamentally different from a stock or commodity.
It is essentially a rigid stream of fixed nominal cash flows stretching decades into the future. You are receiving a fixed dollar amount every 6 months, regardless of what happens in the real economy.
Because those future cash flows are absolutely locked in nominal terms. The present value of the bond today is hypersensitive to the discounting environment.
Small, marginal shifts in immediate systemic liquidity, localized inflation expectations, or the term premium have an outsized, leveraged mathematical impact on the discount rate applied to those distant cash flows.
This is pure duration risk.
Unlike equities, which represent operating businesses with flexible pricing power that can simply raise their prices to pass on inflation to consumers, or commodities, which have direct spot utility in the physical world.
Fixed income is a pure, unadulterated mathematical derivative of the cost of capital.
Exactly. When effective liquidity shifts, the cost of capital shifts, and the long bond reprices instantly.
While that mechanical explanation of duration is flawless, we require a severe humility check regarding the actual statistical magnitude of this singular victory.
Because of the R-squared.
Yes, long-duration treasuries clear the hurdle for statistical significance. We can confidently say the relationship exists, but the R-squared is still only 0.036.
Wow.
Let that sink in. Even in the one single asset class where the mathematical relationship between money supply and price is empirically proven to exist, 96.4% of the monthly price movement remains entirely unexplained by M2 and velocity.
Over 96%.
96% of the bonds movement is driven by institutional rebalancing, foreign reserve management, safe haven flows during geopolitical crises, and raw market positioning. The liquidity signal is real, but it is extraordinarily weak. It is a whisper in a crowded room.
This realization brings us directly to the operational mandate of this series, portfolio calibration.
We are not academics, we are allocators.
If the regressions are this statistically weak, how do we systematically alter our investment framework to protect capital? In our quantitative models, we utilize a mathematical mechanism called the kappa confidence weight.
Explain the kappa weight.
The kappa weight dynamically scales the influence of a macroeconomic data point based entirely on its predictive reliability. Because the explanatory power of monthly M2 is so perilously close to zero across the board, our quantitative framework systematically strips the M2 influence out of the portfolio construction algorithm.
We quarantine the narrative.
In practice, this means our allocation model for gold becomes 94.1% neutral to M2 data. It ignores it.
And the S&P 500?
The S&P 500 module becomes 94.6% neutral. Only the long-duration Treasuries retain a modest, highly constrained 11.7% signal weight derived from liquidity data.
We simply refuse to force a broken, emotionally driven macro theory onto uncooperative mathematical data.
The empirical validation of this disciplined, rigidly M2 agnostic framework is found directly in the cross-asset backtest, running from the start of 2016 through 2024.
This period includes the pandemic crash, the $5 trillion injection, the massive inflation spike, and the subsequent aggressive tightening cycle. It is the ultimate stress test.
By outright refusing to allocate capital based on the flawed monthly money printer narrative, the calibrated framework delivered a 15% compound annual growth rate with a Sharpe ratio of 0.94.
Meaning it achieved excellent risk-adjusted returns with managed volatility.
Compare that performance to the standard industry benchmarks that are heavily reliant on broad, sweeping macro assumptions. It completely crushed the traditional 60-40 portfolio of stocks and bonds, which yielded a mediocre 8.5% return over the same turbulent period.
It vastly outperformed sophisticated risk parity models at 8.1% and the heavily marketed all-weather portfolio at 6.7%.
By actively ignoring the deafening noise of the money supply, the portfolio avoided devastating drawdowns during regime shifts and achieved vastly superior risk-adjusted returns.
Yet, in the spirit of absolute transparency, we must acknowledge the humiliating limitations of our own sophisticated quantitative structure.
The equal weight problem.
Exactly. Despite systematically dismantling the classic, prestigious models like risk parity and all-weather, our highly engineered framework still underperformed a completely blind, naive, equal-weight portfolio over the exact same period.
A portfolio that simply bought an equal dollar amount of the assets, rebalanced, and went to sleep, generated a massive 19.5% compound annual return.
We have to address the irony here. After all the rigorous regression analysis, all the kappa confidence weighting, and all the macro isolation, we lost to a blind spreadsheet.
We must attribute that stark outperformance to the absolute mathematical reality of the 1/n diversification premium, combined heavily with the extreme outsized asymmetry of Bitcoin's historical returns.
Right. When you equal weight an asset class that routinely experiences multiple 1,000% rallies, it permanently skews the entire portfolio performance upward in a way that sophisticated risk-weighted models are mathematically designed to suppress.
Risk models hate volatility, so they underallocate to Bitcoin. Equal weight embraces the chaos.
To summarize our position on the data and the core debate of this initial framework, forcing a long-term, decade-scale macroeconomic story onto monthly tactical data is a severe statistical hazard.
It is a behavioral trap that actively corrupts portfolio construction.
The broad money supply, regardless of how aggressively it expands or contracts, simply does not dictate the month-to-month ranking, direction, or performance of major asset classes. The narrative is dead at the tactical horizon.
The floor remains valid. The monetary floor provides a necessary decade-scale valuation baseline.
The inescapable gravity of the fiat system.
Yes, but I admit it is functionally useless for tactical, month-to-month portfolio allocation. The money printer is a foundational background condition of the financial universe. It is not an actionable trading signal.
Which forces us to ask the ultimate question that will drive the remainder of this 10-part series. If M2 and velocity belong firmly in the background, locked away as long-term context, and they cannot reliably rank assets month to month to generate alpha, what actually works?
How do we build a portfolio today?
The answer requires a complete psychological pivot away from absolute macro storytelling. We must stop looking at isolated central banks and asking, is there more money in the system today than yesterday?
And start analyzing the relative matrix. We must start asking, what is expensive relative to its peers right now?
The future of consistent allocation is driven entirely by relative value, not absolute macro narratives.
We will dive fully into the mechanics and math of relative cross-asset valuation in our next session. But to provide a concrete preview of where the data ultimately leads us, we can look at the current signal matrix for April 2026.
Give us the preview.
The model, having entirely stripped out the money printer illusion, having ignored the noise of M2, is generating definitive, high-conviction, absolute signals. Based purely on relative value across the entire matrix, it is currently calling the US dollar and the S&P 500 strong buys,
while simultaneously rating gold and silver as trim.
The prevailing macroeconomic narrative would scream at you to do the exact opposite. The narrative wants you to sell the dollar and hoard gold.
The data demands we listen to relative value.
This is the research desk officially signing off.